If the United States defaults on its debt, it would be catastrophic for the economy. Millions of jobs would be impacted, the cost of borrowing money would skyrocket, and government benefits many people rely wouldn't be sent on time. But for investors hungry for an opportunity to buy low and sell high, it might not be total doomsday. Markets have been mostly indifferent to the debt ceiling since it was breached in January. That is bound to change as the default date, also known as the X-date, approaches. If lawmakers can't reach an agreement by the last week of this month, it could get very ugly for markets. The S&P 500 fell by more than 16% over the span of 5 weeks in 2011 when the United States narrowly avoided a default, which led to a downgrade of the nation's debt. But 2 months after the downgrade, the S&P 500 recovered those losses and ended the year virtually unchanged. Even if a deal isn't reached in time and the United States defaults, it's unlikely to go unresolved for a long stretch of time, experts told CNN. And when it does get resolved, it's quite possible there will be a relief rally, said Callie Cox, eToro U.S. investment analyst. But there could be a correction period immediately following a deal as the Treasury replenishes the cash it burned through when it couldn't borrow money, said Michael Reynolds, Vice President of Investment Strategy at Glenmead. Should you buy the potential debt limit dip? There's been a lot of reward for when people step in and buy the dip, Cox said. Many investors are still kicking themselves over not buying more stocks at their lows during the height of the pandemic, she added. But you can't look at the market in a vacuum. We have so many other pressures weighing on the economy, she said.